Hi, this is Jack Schwager. The dual trend is a very interesting indicator which is based on the premise of combining a restrictive long-term signal, specifically the trend weight with a high threshold, and a short-term signal, namely TradeShark's long trend difference. Combining two disparate time-based indicators provides good diversification benefits and embeds attractive properties. Specifically, the trend weight will prevent counter-trend signals against the main trend, while the TradeShark long trend difference will provide quick exits on trend reversals. Next, we will look at three different ways of displaying the dual trend signals using the soybean market as an example. Here we have our first example of the dual trend applied to the soybean market. A couple of preliminary comments. The two subplots at the bottom are the two indicators that make up the dual trend. Specifically, the bottom subplot here is the trend weight, and the upper subplot here is TradeShark's long trend difference. Regarding the trend weight, you'll notice we're using a threshold of 80, which is a fairly high threshold. You don't necessarily have to define the dual trend that way. You have the option of setting the trend weight wherever you'd like, but we use a high value to make it a particularly restrictive condition, so it gets maximum contrast with the TradeShark signal. The TradeShark signal is basically negative when it's below the line and positive when it's above the line. Now, this version of the dual trend is a single condition application of the indicator. So that means we only need one of the indicators short. The other can be neutral to give you a short position, or one long with the other neutral to give you a long condition. Of course, if both are long or both are short, then you would have a signal in that direction. But you don't need both agreeing to get a signal. To specify this version of the dual trend, you would need to go to the properties box, go to dual trend, formula, and make sure that this box, dual condition, is unchecked. If it is, that will mean that you will get a signal as long as one of the indicators is long or short, even if the other is neutral. Next, we'll look at the dual trend, but with a dual condition signal. So we'll go to this next chart here. So once again, we have the two indicators as subplots. They're exactly the same as they were in the former chart. The difference is we've gone to properties and formula and checked the dual trend box. And that will only give us signals when both of these indicators are in the same direction. So here, for example, you can see the TradeShark indicator is below 0. You can see the trend weight below -80. And that's when you get both of them together, you're getting a short position. When they're in opposite directions, such as here, where this is short and this is neutral, it doesn't have to be long, you're still getting a neutral. Here, where they're both up, you get a long. And so that's the basic idea. You need both to get a signal, otherwise you're out of the market. And this type of application of the dual trend will give you broad periods where you're basically generally out of the market. Finally, we have a third way of depicting the dual trend by using a strength bar as depicted by these horizontal lines. You may recognize this particular example from video 1, which we previewed this application. And if you recall, basically when you have both bars green, it means both indicators are long. Both bars red, it means both indicators are short. And when you have a yellow, essentially it means that the indicators are in contradiction and you're therefore neutral. And finally, when you have a single color, like single green here or single red here, it means one indicator is either, in this case short, this case long, and the other indicator is neutral. Now, there are basically three ways you can use the dual trend indicator to generate buy and sell signals. First, you could require only a single condition, that is, the dual condition box in formula is unchecked. And that means that even if one indicator is neutral, as long as the other is long or short, you would have a signal. So in cases like here, you'd be long, short, long short, even though one indicator is neutral. The second way of applying the dual trend is to require a dual condition, that is both the indicators to be in the same direction, and that's what the dual condition box checked in formula. And that would mean that you would be long in situations such as this, where you have both indicators long, and short in these phases here where both are short, but you'd be neutral in all of these other cases where you only have a single indicator or basically have the two indicators in contrast. And the third way of using the dual trend indicator is an interesting variation, and it's basically varying the position size depending upon whether you have net one indicator or both indicators in agreement. So when you have both indicators, like both indicators long here or both indicators short here, during those phases you would have a 2x long or short position. When you only have one indicator and the other one neutral, such as these cases here, then you would basically have a 1x position. So those are the three ways you can use the dual trend indicator to generate buy and sell signals. It is useful to directly compare the differences in signal generation between the single condition and the dual condition for the dual trend, and we can make that comparison directly by stacking the charts on top of each other. In the top, we have the dual trend applied to the soybean market, requiring only a single net condition, a net short from one indicator and neutral in the other is enough to get you short, and analogously one indicator long and the other neutral is enough to get you long. And comparing that to the dual trend with a dual condition, namely as in this bottom chart, you need both indicators to give you the same reading to get a position. So both for short here, both for long here. Now, there are two key differences that are readily evident between these two approaches, and they're true in this particular example, and they're true as a generalization, not in every case, but on balance they tend to be true. The first is using the single condition, as you can see up here, when we have a major transition from a bull market to a bear market or vice versa, a major trend change. The single condition will get you in earlier, and that stands to be logical because a single condition can be met easier than a dual condition. You could see the same point in time where we're getting short on the single condition here, and there's a while that passes and a bit of a price movement before the dual condition gives us the short. So you get a better entry with the single condition than the dual condition. The second major difference occurs during this period where we are basically out of the market from the point where we get out of our short position in a dual trend condition here, which is the same point we get out on the single condition, and not actually a very good exit. And we are basically out of the market almost entirely to the current short position, with the exception of this one short-lived trade from the short side, which is essentially a break-even trade. In contrast with the single condition during the same time period, we've got 8 different trades ranging from small gains to small losses, but a bit of a modest loss on balance across all those trades. And so the basic difference boils down to the single condition gives you better entry on trend changes, which is good, but it will also give you more trades back and forth in less than optimal conditions, namely trading range markets, which is on balance usually negative. So each approach has its pluses and minuses, and the important thing is to understand what they are. But both approaches are solid, and it's really a matter of taking the one that is preferable, and that will vary for each trader. Now let's compare the single and dual condition versions of the dual trend for another market, this time the Japanese yen. And as you can see, there's a lot of similarity, of course. The most important thing that they have in common is they both capture the major portion of the bear market in these big periods here. The big differences you can see are primarily in this first half of the chart. Similar to the chart, the soybean chart, during this sideways period, the dual trend is pretty much out of the market, with the exception of this one short-lived trade. And the single condition, though, gets a number of back and forth trades during this narrow sideways market. It also similarly gets an earlier entry into the major downtrend. We're going short here, whereas the dual trend condition is equivalent to entering here. So considerably later in time, but in this case, not a great deal of difference in terms of price. We'll finish our survey of the dual trend indicator by taking a look at a stock example, namely Apple. But before we do, let me just comment that stocks have certain distinctions that merit separate discussion, and we will be covering the application of the Jack Schwager indicators to stocks in a separate video. But here we'll at least provide one stock example, in this case, as I said, using Apple, and on the top, as before, we have it with the single condition dual trend, and in the lower chart with the dual condition dual trend. And you can see in both cases, we basically capture the major portion of the uptrend that occurred in the stock during this past year. The major difference between the two, you can focus in on this ending period in this case here. You can see as far as a dual trend condition, during this period we're essentially out of the market with one very short-lived long trade. In the upper chart you are in several trades during that same period, and it's essentially again a period where we have sideways action. But again we see the same pattern where you do get long at an earlier point when the uptrend resumes, namely here with the single condition, and that corresponds to this point. You get in later with the dual condition. So to summarize, both ways of using the dual trend can be effective ways of trading the markets. As a generalization, the single condition application will get you into major trend reversals quicker at the trade-off of generating more back and forth trades during sideways markets where the dual trend condition will tend to be out of the market. So this completes video 5. The instruction videos for the Jack Schwager indicators will continue with video 6, where we will detail 9 different ways of using the trend weight and the directional weight to trading the markets.